If we look at the US dollar index, which tracks the dynamics of American currency versus currencies of 6 US major trading partners, we can see that after the Federal Reserve, the US dollar was rather stable. This is the daily chart, and we can see that the US dollar index was fluctuating and is fluctuating around 95.50 mark. This is at the center of the symmetric triangle. The US dollar is trading right now, and it is a very good reflection of the fact that the market is waiting for some new driver for the US dollar in order to break through these ranges and to show another leg of a movement which has its specific direction. So for now, we don't see such drivers. And it's interesting to make our assumptions whether we'll see any of such drivers in their upcoming week. We have our slide with economic calendar, but let's speak a bit about the US dollar in greater detail. We can see on this small picture on the right, these are the latest data for the market's expectations about the Federal Reserve's interest rate. And this data from Chicago Mercantile Exchange shows us that 55.7% is the possibility that the Fed will increase its benchmark interest rate from the current level of 0.25, 0.50% to 0.50, 0.75%. On last Thursday, this possibility was less. We had almost 50-50 chance that the US will leave rate unchanged and that the US will raise rate. However, on Friday, we got some positive news from the US, and in general, statistics released in America last week was rather positive. US GDP growth for the second quarter was revised to the upside from 1.1% to 1.4%, and the durable good orders didn't decline in August as strongly as it was expected. In addition, the Fed Chair Janet Yellen said that higher rate will likely be appropriate this year. So this statement is in line with December rate hike from the Fed. However, of course, the market will be watching the incoming data, and in order to see whether this data is enough to for the Fed to actually raise rates, because we have to see some measure improvement from the figures we saw up to September for the Federal Reserve to change its view on interest rates and to actually deliver this long-awaited interest rate hike. Yet the situation is not so simple. It all doesn't come solely to the US economic data. We have two more important factors to consider when we try to predict when the Fed will raise interest rates. And these factors are US presidential election, which will take place on November 8th, and also some external factors which may prevent the Fed from raising the rate. Firstly, let's say a couple of words about the US election. Traders will keep watching the battle between the Democratic nominee Hillary Clinton and the candidate from the Republican Party, Donald Trump. We saw last week the first debate between these two presidential candidates, and according to opinion polls, 52% of likely voters said that Clinton won the presidential debate, while 21% felt that Donald Trump was the winner. Clinton is perceived to be good for US stock market and bearish for the greenback, while Trump, on the contrary, is associated with unpredictable policy steps and some kind of policy steps which are aimed to strengthen the US dollar via some trade policies to make America more protective of its goods and the US dollar. As a result, Trump's victory would be bullish for American currency. For now, Trump is not a leader in this battle. However, his results are still far better than economists and experts used to predict. And as long as we don't know for certain that it's Hillary Clinton, not Donald Trump, this uncertainty will remain in place, and the uncertainty in this area is a supportive element for the US dollar. Another factor, I also want to add that as long as uncertainty exists, the Federal Reserve can't make this decision to raise rates. It is very difficult for the central bank to act before we know that economy and US political system will be moving in this or that direction. So we have to wait until November 8th, until the result of election. And in my opinion, even if we will watch the speeches of the Federal Reserve's members, which come ahead of this event of the US election, still they won't say what they actually think, what their actual plans are before we are not done with this election stuff. And the second important factor for the Federal Reserve and its decision making is what is happening in other economies. We remember that after the first rate hike in this cycle, which took place in December 2015, there were great problems in China. Then there was uncertainty related to Brexit, which prevented the Fed from raising interest rates earlier this year. And the current situation, the current problems with the European banking sector and primarily with Deutsche Bank can lead to uncertainty, can lead to a crisis, and this crisis may prevent the Federal Reserve from a rate hike. So Fed can say that, look, the situation is too uncertain, we have to keep our monetary policy accommodative in order to make sure that the financial system and the economy survives these negative consequences. So it comes not only to the US data and how good US economy feels, but also to the overall stability of global financial market. If banking crisis in the euro area starts to manifest itself more pronouncedly, if troubles escalate, then the Federal Reserve won't be able to deliver this hawkish stuff and to raise interest rate. So the current environment is rather complicated for the US dollar bulls. We see that if we try to return to this dollar index chart, we see that American currency lacks these reasons to take off and to break above this resistance line. Maybe after the US election, after if the European problems with banks will be resolved, or the market will get sure that they will be resolved, the possibility of the Federal Reserve's rate hike will get higher and higher, then the US dollar will be able to show significant gains. For now, it is stable. There are reasons why it is stable. Risk aversion should keep the US dollar rather balanced. The risk of the Federal Reserve rate hike will exist, and even if this risk doesn't provide a reason for the US dollar to get much higher, it still supports the currency. So in my opinion, in the near term, we have the risk of lower dollar, but not low enough to make a significant break of this support line in the US dollar index. The upcoming events we have to watch this week include ISM manufacturing PMI. The release will be in a bit more than an hour. Then there will be vice presidential debate on Tuesday. The candidates for vice presidents will just discuss and battle on key economic and political questions, so it will be also important for the election campaign. ADP non-farm employment change is due on Wednesday. Unemployment claims will be released on Thursday, and on Friday we'll get a very busy day with non-farm payrolls, or NFP, with average earnings data and unemployment rate in the US. This is a block of labor market statistics, and also we'll have the speeches of a vast range of Federal Reserve speakers, and they will likely evaluate American economy, maybe external situation, and will give their opinion on the Fed's policy. So this day, Friday, should be most important for the greenback. Once again, I'd like to point out that American data should be very, very good in order to sustain expectations of the Federal Reserve's rate hike. So some extraordinary figures are needed to provoke a rally in the US dollar, while the readings which are close to consensus forecast probably won't generate a strong rally, strong appreciation of the US dollar.